Hello, my friends. Today is August 10th, and this is Markets Weekly. Now, this past week was a super exciting week in markets, so much so that we had an emergency podcast on Monday. Now, at times, it was pretty scary, but now, at the end of the week, as we look back, we have to wonder, was it all a dream? So today, first, we're going to talk about three things. Let's summarize what happened this past week. Secondly, let's talk about how the market seems to have scared the Bank of Japan into backing off on their rate hike plans. And lastly, let's look at some new research from the New York Fed looking at post-pandemic labor market structures and suggesting that there really has been a structural shift when it comes to internal migration and the demand for labor across different occupations. Okay, starting with price action. So just to summarize, in case you've been living under a rock, on Monday, we had a tremendous crash in the Japanese stock market. The Nikkei was down 12%. Now, 12, big number. This is not a penny stock. It is their stock market index. Now, can you imagine what the world would feel like if we had a 12% crash in the S&P 500? At the same time, we saw the Japanese yen appreciate significantly. Now, many market participants looked at this and attributed it to the unwind of the yen carry trade, and that obviously hit global asset prices where the S&P was down 3%. Now, in addition to that, we also had a tremendous spike in volatility with the VIX as high as 60. Now, that seems to be the unwind of another very popular trade, the short vol trade. Many good podcasts on that. I recommend the recent one on Odd Lots with Charlie McElliott. So all that unwind really did seem to panic the markets. But fast forward to today, it looks like things are actually surprisingly retraced. So looking at the Nikkei, we were down 12% on Monday, but today basically flat on the week. The Japanese yen appreciated tremendously, but at the end of the week, not much has changed. And looking at the S&P 500, of course, we were down a lot, but now the market basically retraced all those losses. But one corner in the market where the market retains the trauma is in the VIX. Now, volatility spiked tremendously, but it looks like those vol sales came right back and pushed volatility lower. However, we are still comfortably above 20 on the VIX, which is much higher than last week. So there are some places in the market that have not fully recovered, but perhaps over time, as we see usually in these spikes in volatility, we'd have more vol sellers, market participants become more complacent, and that could go back down. Now, it seems like there are a couple things this past week that calmed the market about calm market participants. So the first is that US data continues to be totally okay. It seems like part of the reason for the scare, it was basically a growth scare. Market participants saw that the unemployment data from last Friday was not as good as expected. In fact, we saw a large spike in the unemployment rate. Now, many people are looking at this and extrapolating towards a recession, and the market is very afraid of a recession. But this week, again, we got data. Well, it's kind of summarized in the Atlanta Fed's GDP Now, which continues to show a very healthy above-trend growth in the economy. Secondly, we also got labor market data, the initial unemployment claims that were better than expected, and a notable decline from last week. And that seemed to calm markets a little bit as well. Now, like I mentioned on Monday, we are probably in a choppier, higher volatility regime. And so while we bounce this week, and maybe we'll continue to bounce, I think things are more cloudy than they were, say, just a week ago. So let's see what will happen. Now, the other thing that seemed to calm markets a bit is our next topic, and that is the apparent pivot by the Bank of Japan. So this past week, obviously, tremendous volatility in the markets centered on Japan. Now, just last week, the Bank of Japan held their monetary policy meeting, and they made a couple big decisions. First, of course, they hiked rates to 0.25%. Sounds not a lot, just barely above zero. But remember, Japan has been in negative rates for a long time, only recently went to zero, and now they're hiking to positive. The other thing that the Bank of Japan did was they announced quantitative tightening. So we all know the Bank of Japan buys an enormous amount of Japanese government bonds. So what they decided to do was to reduce their monthly purchases. That, in effect, is quantitative tightening because that means that their redemptions, so the amount of their bond holdings that mature, is going to be greater than the amount that they reinvest each month, resulting in a shrinking of their balance sheet. Now, this was interpreted as a hawkish signal from the markets, and Bank of Japan Governor Uedo also seemed to make hawkish noises. Now, of course, things obviously changed because when you see your stock market absolutely plummet by 12% in a day, you got to think that, maybe that's not a good thing. And listen, this is, if you are the prime minister or something like that, this is a financial stability and ultimately an election concern. So we have this other guy from the Bank of Japan come out and give a speech. Who is this guy? Well, let's take a look. Now, if you look at the website, you will see that this Uchida guy is a deputy governor, literally right next to Governor Ueda. So it seems like an important person. So he came out and gave a speech, and the Bank of Japan is very courteous. They translate their speeches into English. Of course, they know that being a major central bank, being a big country, their actions are regarded are seen by market participants throughout the world, and so they want to make sure that market participants understand what they're saying. Now, in his speech, Deputy Governor Uchida does boilerplate stuff, but one thing that jumped out to me as I go through this is that, well, first, let's look at the structure of this. You have big paragraph, and then you have this very, very small paragraph that seems to be highlighted. And in that small paragraph, Dr. Uchida is strongly suggesting that, he's happy with rates as they currently are. Now, after the BOJ meeting last week, the expectation for the market was that the Bank of Japan would again hike in October. Now, Deputy Governor Uchida seems to be suggesting in his speech that, we were saying this was going to happen, but look, a couple things have happened. First, of course, our outlook was conditioned on a whole bunch of stuff, and now the circumstances have changed. We have tremendous volatility, and that matters. The second thing that he mentioned was that part of the reason why we wanted to hike was because the yen was very weak, and that was leading into a higher inflation domestically, and that was causing problems for us. Now, after this massive appreciation of the yen this past week, it seems like that rationale is not there anymore. So, we don't really have to hike in October. And the markets, of course, knew this even before he spoke. If you look at the 2-year Japanese government bond yields, in response to the panic on Monday, they already priced out the rate hike in October. Now, Deputy Governor Uchido's speech, of course, was greeted by the market with enthusiasm. After the speech, you can see the Japanese yen rapidly depreciate and the Nikkei surge. So the markets clearly interpreted this speech as, to some extent, a pivot by the Bank of Japan, whereas they were going to hike, they were being hawkish, now they are not anymore. And I understand there are people on the internet who see this differently, but it seems clear to me and the market as well. One other thing that I would note is that I've noticed that when policymakers speak to the public, foreign policymakers speak to the public, they are often very blunt. This is because they understand that many people who listen to them don't speak their language, and they want to be as clear as possible. For example, ECB President Lagarde, when she goes and she talks, it's actually super blunt. I recall when the ECB was hiking rates, they were very afraid that the market would price in too early a cutting cycle. So Madame Lagarde would always go on stage and say, guys, no pivot. All right, by the way, guys, no pivot. So this is basically the troubles of communicating to an audience that doesn't speak your language. So again, when they speak to foreigners, totally blunt. So maybe there's something secret in the speech in Japanese that suggests otherwise, but as far as I read in English, and this, of course, document was intended to an English-speaking audience, it seems like the Bank of Japan is backing down on their hawkish trajectory, and the market likes that. So that's reducing a bit of pressure on the market. And in the future, if things calm down, if data changes, maybe they will continue on their hiking trajectory. But at the moment, it looks like that's easily on pause. Okay, now the last thing that I want to talk about is this interesting data from the New York Fed about the post-pandemic structure of the labor market. So one thing you'll notice, I think many of us have noticed over the past few years, is that the pandemic resulted in tremendous internal migration. Now, this can be seen in this cool graph from the US Census Bureau showing that, if you look at the dots, tremendous movement out of New York and California into states like Florida, Texas, basically from the huge megacities to medium-sized cities. Now, what the New York Fed has done is that they've looked at job postings over the past few years and noticed that this migration trend actually also structurally changed the demand for labor by occupation. So what they did was they looked at job postings, online job postings, millions of them, and they noticed something really interesting. Well, first off, what they've noticed is that in the past, the megacities like New York would have a large proportion of job postings. Big cities were where the jobs were. Now, post-pandemic, though, you can see that there's been a steady shift where the proportion of jobs in the megacities has been declining, but the proportion of jobs in medium-sized cities has been rising. And in fact, this trend seemed to have slightly began even before the pandemic, but the pandemic accelerated everything. So what that seems to suggest is that more and more people, perhaps because they can because they can work remotely, they are moving elsewhere, maybe taking their jobs with them, or maybe it's simply a lifestyle choice where they feel like they can afford a home in a medium-sized city, whereas it's very difficult to afford a home, say, in Los Angeles. Now, in line with this, though, they've also noticed that the researchers have also noticed a very interesting shift in the types of jobs posted. Now, looking at this graph, you can see that there's been a steady decline in the demand for occupations in tech and finance over the past few years, but a very strong increase in the demand for things like healthcare. Again, that's a structural shift in how the world works. Now, they do something super interesting in that they cross-reference these two charts. Again, on the x-axis, you can see occupations. On the y-axis, you can see size of the city. And then they color-code it by showing you where among this grid you have increases in jobs and where on this grid you have decreases in jobs. Where the red strongly shows that there is a strong increase and the blue shows a strong cooling of demand. And what's super interesting in this is that they're showing that there is really a significant decline in demand for tech work, stuff like that, computational work in big cities throughout the pandemic. You can think of maybe the kind of the collapse of San Francisco, which is in line, of course, with their decline in offices and so forth, but also a surge in demand for things like healthcare and food preparation in medium-sized cities through the pandemic. Now, their interpretation seems to be that as people have migrated out of the big cities and into medium-sized cities have surged in their population, and in proportion to the population, you also need more healthcare, you also need more restaurant workers and so forth, and that seems to be rewiring the labor market in the U.S. And I would also add there's probably a demographic element as well as as boomers age, maybe they're moving to warmer, smaller cities and taking with them their money and, of course, their need for healthcare. So this seems to suggest an ongoing shift where maybe the growth, the opportunities are in the medium-sized cities going forward rather than the megacities as they were before. That seems to make sense to me and what I believe as well. Okay, so that's all I prepared for today. Thanks so much for tuning in. Don't forget to like and subscribe. And if you're interested in hearing more of my thoughts, check out my blog at fedguy.com. All right, talk to you all next week.